Good evening. This is the Angry Capitalist podcast. I trust this finds you well. In this episode, I'm going to cover a tool that was introduced to me a few years ago that as soon as I found it, I instantly fell in love. And this is the asset periodic table. For those of you who are interested in finance, investing, business, anything in that space, the word asset gets thrown around quite a bit, as does as do different types of assets, and it can get a little bit confusing and murky, and it's like, well, what are all of the assets that are out there exactly? And this is a chart that is based upon the periodic table of elements, but it's applied to assets. And I'm going to go ahead and end my camera. Doop. And I'm going to go ahead and pull it up for you guys. Bear with me here. Doop. Okay, there we go. So the center diagram, just like the periodic table of elements, explains kind of the layout of the chart with an example for you. So as we go through this, in the upper left-hand corner, you have a risk a risk number, risk analysis. Risk analysis or risk number. So you've got different numbers, and then you also have NRs, which are not rated. The NR would apply to things that are such variance within the asset class that it's near impossible to rate it. You then have the border of the different assets within this chart, and the darker the border is, the less liquid the financial instrument is, or the less liquid the asset is. When I say liquid, I mean transferable or convertible into a currency. We then also have risk, and it goes the darker the color, the riskier the financial instrument is. So the risk analysis number, it's giving us a numeric scale, but in absence of that, the shade or the darker the color is within this chart, the more risky it is. And you can see that at the very top we have quite lightly shaded in boxes, and then as we go towards the bottom, they get darker. In this video, I'm going to be focusing on currencies. So what I'm looking to do is I'm looking to go left to right across the different classes of assets. And likewise, we do have different classes and then specific examples. So we have currencies, we have fixed income, equities, structured products, private equity, real estate, infrastructure, commodities, and collectibles. Now, for this video, I'm going to go ahead and leave the table up just so that way you can go ahead and use it to follow along. Now, let me go ahead and pull up my notes here. One sec. Okay, there we go. So, currencies. First off, we have cash. Now, within the context of this table, it refers to cash, but I would say it's a little bit more specific to the US dollar. This could also apply to different countries' cash, of course. But when it comes to the risk analysis, you're looking for more of a reserve currency status. So, cash, when I say cash, I'm referring to USD. We'll go into foreign currencies in a little bit. And I think that will give a little bit better explanation for why, when we refer to cash within the context of this chart, it's specifically US dollars. So the risk number is 1. That is extremely low. What risks are there in regards to cash? Number 1, inflation. We then also have destruction and theft. So, as an example, if you have physical cash sitting in a vault, the risk to it is that it could inflate. Your vault may not be fireproof or waterproof, so if there's a flood or a fire, it could be destroyed. And likewise, it could be physically stolen from you. And it is very liquid. It is the most liquid asset there is, very transferable. Next, we have what are called high yield savings accounts. The risk on these as well is 1. The risk factors to it is inflation exceeding the yield that you're getting on the savings account. So if your currency is being devalued at 5% and your money sitting in your high yield savings account is getting you a yield of 2%, you're theoretically or realistically losing 3% of the value. So 5 is the inflation number, less the yield. That is how much you're being devalued by. Of course, theft is still a concern here as well, in case your account somehow gets hacked. But that's a relatively lower risk compared to it being just physically stolen from you. And of course, this is also very liquid. Next, we have a certificate of deposit. These are also called just CDs. Risk level is 1. And once again, we have inflation exceeding yield. I did not put theft down for this because in order to redeem a CD, there's a little bit more protection that goes into it in regards to redeeming it with your bank. So theft is much less of a risk in this case. However, the inflation exceeding your yield with a CD, because it's a timed instrument, is a little bit more of a concern. In this case, we have moderate liquidity. So once again, it's tied up for a period of time. You can't just go ahead and spend this immediately like you could from physical cash or a high yield savings account. Next, down below that, we have what is referred to as a money market. The risk level on this is also 1. Once again, inflation exceeding yield, moderate liquidity. For the average person using this, once again, very similar to a CD in that it's a timed instrument. There's some more nuanced difference between a money market account and a CD, but for our purposes, once again, it's just the inflation exceeding the yield that you would get on the money market account. Next, down below that, we have what are referred to as short-term treasuries. So these would be effectively government debt instruments. So I was a little thrown off as to why this was put in the currency category myself at first. However, I do think it makes a certain amount of sense just because of the time variable on this. So once again, this would be a treasury bond. So that is a debt instrument, pretty similar to a CD or a money market. When we're talking short term, we're usually talking about, as an example, 3, 6, 12 months. Risks in this case, once again, you're going to get a fixed yield on it. Your concern there is that the rate of inflation will exceed the yield. Likewise, there is an added risk factor here that I think you should be aware of. This is that the market value of a short-term treasury, so you could redeem that treasury bond at any point in time. However, the market value of that treasury will vary from time to time. And as we recently had, or not so recently, as we had happen last year in 2023, if you have increasing interest rates, meaning the amount of interest you could get on a brand new treasury versus your treasury that's a few months old, if the amount of yield on it, because of an increasing interest rate environment, is lower than what is currently being produced, that could decrease the market value of that treasury. So you'd either have to hold on to it until maturity, or if you need to sell it and redeem it, you would be redeeming it at a loss. And in this case, because there's a bit more difficulty in terms of cashing out of these are rated at a low liquidity. And the risk number on these, once again, is 5. Next, we have foreign currencies. Risk is not rated. Risk factors that could occur here would be sovereign disputes, market fluctuations, and inflation to hyperinflation. As a brief example, this would be like comparing cash, and when I say cash, I'm referring to USD, US dollar, to the yen, the yuan, the euro, so on and so forth. And when it comes to sovereign disputes, as an example, with Russia at the start of the Russo-Ukrainian War, there is the concern that if you were holding rubles, one, because of a war breaking out, those could fall in value. Second, other countries may not allow you to redeem or to exchange the sovereign currency that you have put your money, your value into, for USD or some other currency. Likewise, for example, let's say people hold yuan, right? There could be a sanction put on China to where you can no longer redeem yuan for dollars. So that's something that you need to have in mind in terms of a sovereign dispute. Currency markets fluctuate constantly day to day. Definitely not myself, but some individuals that I used to know when I was in the military, in the Marine Corps, when we were in Japan, would actually turn in, they would withdraw and deposit their money back and forth, or exchange it back and forth at the exchange desk on base between US dollars and the yen to increase the value of what they had. So they're just exchanging, they're effectively exchanging currencies physically at the exchange window. And they would do this on the day-to-day because the yen may rise or fall in relation to the dollar. And so that's something you need to keep in mind as well when it comes to foreign currencies. There is also some regulation within the US, as well as various other current countries, about doing currency trading. And of course, the big concern if you're investing in foreign currencies, in my opinion, is inflation. So there's always the possibility that a given government may just go ahead and, for whatever reason, be it a crisis or a change in regime, they may start printing their currency like mad, thus devaluing it. And in this case, we have moderate liquidity. If you're holding physical currency, you do need access to a trading window, or in some brokerage accounts, you can also trade currencies in that regard. So moderate liquidity when it comes to foreign currencies. Next, at the very, 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 very bottom of the currency stack in terms of risk tolerance, we have cryptocurrencies. Risk level is 99. That is the highest risk that is within this chart. A brief note back to the foreign currency, just because that's a good example of the risk evaluation system. The reason that the foreign currency asset is not rated is because it frankly varies by the currency as well as by the point in time. So because there's that temporal variance as well as difference between different specific currencies, it was not rated. There is no way to rate all foreign currencies because they're not equal. Now, with cryptocurrencies, however, they did give this a risk rating and they did put it down as 99. The risk specifically does also vary by the exact cryptocurrency. And it does also vary depending upon the the sovereign regulation that you're dealing with, as well as whether it's being held in a separate wallet or if it's being held in a brokerage account. Likewise, once again, there's the issue with sovereign regulations. Various governments around the world do not like cryptocurrencies because of the lack of control, and so they may put regulation on their usage, as well as whether you can even buy it in the first place or sell it. Likewise, there is also a concern of theft, of scams when it comes to cryptocurrencies. You really have to know what you're doing. And even in that regard, it's still it's still the Wild West, so to speak. I don't know enough about cryptocurrencies, but from the individuals who are more into it than I am, what I've commonly heard is your best bet is to go with Bitcoin because it's the most sound crypto out there, and also that you should not hold it in a brokerage account, that you should hold it in a physical wallet that only you have the access keys to. Now, outside of in terms of liquidity to exchange it back for cash, outside of a brokerage account, I deem it to be very low liquid. And also just because the volatility is such an issue there, to get the exact or better conversion between a given crypto and US dollar, the volatility does also play a factor, in my opinion, when it comes to the liquidity. If you're investing in a crypto and it shoots up 25%, awesome, great. But if it drops down by 25%, or if it drops significantly, or if you're talking about what's called a meme coin, look into that more on your own. But a good example is Doge. There's the high possibility that a given crypto could collapse completely to where you can't really withdraw it anymore, at least reasonably. back into a more conventional currency such as cash or US dollar. So, this concludes the first episode that I'll do in the asset periodic table series. I hope you do enjoy this. I'm going to go ahead and link the periodic table of asset classes within the description below. So you can go ahead and check it out. Or likewise, if you just Google periodic table of asset classes, it'll pop right up for you. So you can download it at your convenience. The next video that I'm going to do in this series will be in regards to fixed incomes. So I hope you enjoyed. If you have any specific questions or comments, points where maybe you disagree with the outlay of this table, go ahead and drop that in the comments down below. If you have any personal experience, stories, anecdotes in regards to the different types of assets that I've laid out in this video, also go ahead and drop those down below. I would love to hear from you, especially if there's anyone who's willing to talk about openly trading foreign currencies that perhaps may have had a good amount of success doing that. With that being said, if you enjoyed this content, like the video, subscribe, and ring the bell so you get further updates when I release content like this. And take care.